Good morning. It's Monday, 9th of April 2018. Welcome to Real-Time Daily Trading Ideas. We have 5 days a week, 5 different traders. We will speak about trading ideas, strategies, market screen, and maybe 1 or 2 questions from your side directly answered in our webinar. Our goal is quick, but for that daily, so let's have a nice start like every day. And like every day, we will start with a risk disclaimer. Forex and CFDs are leveraged products and can result in losses that exceed your deposits. If you are a starter, please start with a demo account and make yourself familiar with long trading, short trading, leverage trading, and your personal risk management. If you'd like to read the full risk disclaimer, just visit one of our web pages, for example, admiralmarkets.com, and you will find everything displayed there. This is me. I'm talking from the Berlin office from Admiral Markets. I'm the German guy, so my English is made in Germany, but hopefully some of my quality too. But I'm not the main speaker. The main speaker is the day trader of today. This is our scheme. On Monday, like today, it's Jay's day. On Tuesday, it's Paul's day. On Wednesday, it's Giancarlo's day. On Thursday, it's Senat's day. And on Friday, it's Dirk's day. Our leading day traders live. And of course, if you like to trade Forex and CFDs, we would be happy if you do it with us. Many benefits only at Admiral Markets. For example, one of our bestseller DAX 30 typical spread of just 0.8 points to the main trading hours. You can trade mini lots, you can trade with MT4, MT5, and everything with a safeguard negative balance protection policy. Check all details out on admiralmarkets.com. There you will find also something about our regulatory background and how to contact us. You can call us, you can send us an email, or visit the other channels like YouTube or Facebook. Mostly all the webinars will be recorded and a couple of hours later available on YouTube channel. Enough from my side. Now it's time for the institutional Forex view. That is the usual view from Jay. Hi, good morning, Jay. Now it's your turn.
Good morning, traders. Good morning, Jens. Thank you for the nice intro, and good morning to all of you. We have quite a lot of you guys coming in. Welcome. I hope you all had a very good weekend. Let me show you my screen so we can get going on today's morning session. Monday morning, we're going to have a look at the markets, and to start off, let's have a review of our last trade. That was 2 weeks ago because last Monday we had a holiday, and as you can see, we were longing the Kiwi against US dollar, and that trade is still open. And what's interesting is that a couple of days ago we missed our profit target by 3.2 pips. But we saw some reaccumulation and we're still on target, so I'm pretty confident that we can get to it this morning, Kiwi being the strongest currency in the London session so far. Headlines to start: we keep an eye on the trade war between the US and China. China said it is studying currently the renminbi devaluation as a tool in this trade spat. This is according to Bloomberg, so we need to keep an eye on that. We also had a few of the Chinese advisors to the political party there stating that the stopping of investing in US treasuries could be used as a nuclear option. Jeff Grundlock of DoubleTree, one of the largest and most important and prominent hedge fund managers in the world, recently stated the obvious. He said, well, if they sell their treasuries, they may be hurting the US, but on the other hand, they are losing the tool to pressure the US. So we'll see how it goes. Over the weekend, Trump tweeted, and let me remind you, if you're still not on Twitter subscribing to Donald, then you are missing the opportunity to make some money. He tweeted a softer tone, was mentioning President Xi per verbatim, so the equities in Asia recovered a little bit. Speaking of equities, here's an important slide for you guys. A lot of people, especially in the retail space, do not know this. So for you, since you come up, get up early on a Monday morning, let me tell you this. Over the last 10 years, with central banks around the globe printing money, we had the occurrence that institutional investors as well as retail investors were sellers of volatility in order to what we call clip a coupon, i.e. make monthly income. Also, we had billions of dollars flowing into exchange traded funds in a passive investment manner. So no longer stock picking, but basically ETF strategies can be come up and thought up with on a press of a button, short historic performance measure in there. Nothing ever traded for real, but it cost a lot of money to actually flow into passive investments based solely on the premises if the underlying stock is liquid enough for these large institutional flows to be absorbed. And finally, tons of money went into what we call risk parity funds. These are funds that are in a position to weight their investments according to a mathematical formula. And what you don't know, and most of you, and let me hopefully enlighten you on this, is that there's a difference between implied volatility and realized volatility for different underlyings. And the implied volatility is what the options market maker charges you in order to purchase this, let's call an option an insurance policy, in order to purchase this insurance policy. So the more risk the market maker of the option perceives for the future, the higher the implied volatility, i.e. the more expensive the option. The realized volatility, i.e. after these options expire or are actually executed, is historically, systemically lower than the implied volatility. And intuitively, that makes sense. If you think about an insurance company, they charge more for their premiums, and they have to, because not everyone who has health insurance also falls sick, i.e. the insurance model works. But, and this is important, the 3-month realized vol, if it rises above 15, these risk parity funds are net sellers of stocks. And we are above 20, as you can see. Actual volatility is 20.87 on the S&P. So the formerly buy the friggin' dip mantra is broken, okay? Because we do not have volatility sellers in the background, and we do not have risk parity funds as net buyers in the background. So beware of this is all I'm saying. I'm not advocating that the market is crashing, even though we're having lots of problems at the moment, but this is something that you need to keep in the back of the mind if you're looking to be a purchaser of equities, be it in the US or in Europe. That risk parity bid, that constant bid of people coming into the market to buy is gone for now, okay? They're net sellers, so keep this on the radar, please. And if you want to buy a dip, wait for a deeper dip, please. Okay, this morning, strength versus weakness. This was real early. Oh, this is wrong. This is from last week. I apologize. As I alluded to, Kiwi was the strongest, and then Aussie was also very strong until that CNY headline hit the tapes, and then Aussie dollar got hit due to its closeness as a trade partner to China. What do we have in terms of risk events? It's actually quite a thin week. We don't have that much going on. We have lots of speakers, so we want to keep an eye on it. And I'm not going to go through every single one, but let me focus you on PPI on Tuesday in the US and core PPI. And that's the producer price index, i.e. In the value chain, the input costs. And if they're rising, which they are not expected to, in fact, they're expected to come off a little bit, that means inflation pressures are not there. Also keep in mind that most of this cost is being passed on to the consumer. And we have CPI and PPI out of, as you can see, expected lower than last time, i.e. global inflation not really rearing its ugly head. Then we have manufacturing production out of the UK on Wednesday. That's expected to come in a little bit ahead. And we saw some significant strength already this morning in pound. So money is flowing back into the pound. Also on Wednesday, we have CPI and core CPI. I'll say a couple of things about that in a sec. So as you can see, core CPI expected in line and CPI month on month also expected weaker. Where is inflation? Dollar FOMC meeting minutes also on Wednesday. I'll speak on that in a second. Then we have Thursday, the ECB monetary policy meeting minutes. And we have claims out of the US on Thursday expected to be still in line actually slightly bullish. That's a leading economic indicator. And then due to the trade war, for the first time, even you hopefully will be looking at the trade balance out of China. And that's actually expected to be less than last time. So the surplus is expected to decrease. And if this number is shrinking, that's actually an implication for a weaker renminbi. Last but not least, another leading economic indicator, University of Michigan consumer sentiment, expected to come in slightly below last time, and last time, as indicated here in red, already a miss. We call it a miss if the number comes in below expected. Also recall last Friday non-farm payrolls, also very disappointing, hence the dollar came off a little bit. All right, on we go. If the computer wants to play along, hello, yep, thank you very much. And the date is wrong. Only had 2 coffees this morning. That's not good, I apologize. Wednesday, FOMC meeting minutes. Recall, please, last time we hiked 25 basis points. We're up at 1.5 to 175. Also, keep an eye on your swap rates when you trade and you hold position longer. New Zealand US dollar, for example, is now neutral to at times slightly negative. So that used to be New Zealand dollar used to have the best carry rates. Now the US dollar is even up there with New Zealand. Median view last time was for 3 hikes in 18. Market was sort of expecting maybe even 4, if you may recall, but wage growth is not there and inflation is not there. So that's why Powell said, let's stay with 3, and the dollar came off and the rates in the short end came off a little bit. So traders will now look at these minutes and check if they had a discussion during the meeting about and on recent market volatility and moves. Try to think about it this way. When Bernanke was the boss of the Fed, we, the market participants, institutional side, we always were aware that there is a Bernanke put, i.e. if equities tank, the Fed will come and rescue us. Then he passed it on to Yellen, and Yellen was his student. So there was a Yellen put, okay? If the market would tank, Yellen would be there to rescue our butts. Now, the question is there a Powell put? If so, where is it? We all expect it to be lower than where Bernanke and Yellen were willing to step in to support the markets. Where is the Powell put, and is it there at all? We also note that President Trump used to love to tweet about the stock market going higher. That's also changed. Now he says he is willing to start renegotiating trade agreements, especially with China, his main focus point, and he is willing to take short-term equity pain, read sell-offs, and he's willing to go through that. So rallies on equities, got to be careful in buying these at the moment. 230s, i.e. 2-year yields versus 30-year yields, that is called the curve. The yield curve in the US continues to flatten. That is also a bearish sign for equities. Wednesday we have CPI, we said that, and the core CPI year on year is expected to reach 2%, and that's the first time since March 2017. Before we all get all excited and say, hey, there's inflation, finally we're at the 2%. No, back in March 17, they changed the calculation of the basket. Oh, sorry.
Finance Minister noting that he's agreed to continue working in line.
Sorry. So that's the squawk. So where was I? Okay, in March 17, they changed the calculation of the basket, and they said, okay, cell phone data packages are cheaper, and that caused a big one-off drop, and then it shaved 20 to 30 basis points of course CPI since March 17. So don't get too excited. Inflation not really there yet. Oil also coming off. If I look at the ticker, yeah, we're at 62.31 right now. Euro, Thursday monetary policy account. We all recall last time they dropped their wording on extending QE purchases and or their size. Also be aware, please, that on Wednesday, Mr. Draghi is speaking, and the traders will gauge if his content is going to deviate from the last policy communication. He does that at times. i.e. if you're sitting in front of the screens, be ready to trade because volatility will ensue and you can make some money. Market expects June-July meeting to be the most relevant as the PSPP concludes in September. So September, we expect the purchasing program to end, and we expect the June-July meeting to be relevant because then they will tell us how they are how they intend to continue. Base case currently priced in by the market is for the first ECB rate hike to be mid-19. If anything in their communication changes, the euro will react immediately and you can make some money. Asia, only focus there right now is the trade war with the US. Recall 2-3 weeks ago, I taught you about the tick data, and I said this actually measures how much China buys US treasuries, what quantities. And China currently holds 1.17 trillion US dollars of US debt. That was the January reading, and it's hence the largest foreign holder of US paper. Foreign holder, okay? Obviously, they're the gigantic holder of their own paper. This could be a nuclear option if they decide to stop purchasing US paper. We don't expect them to do this. We are hearing out of China this morning that they're looking to mess with their currency, and that will be painful for the rest of the world, i.e. read Forex currency wars. This is what this is alluding to. Friday CNY trade balance will be closely watched. PMI import and export orders, these are leading to the trade balance, came off, and hence the market is expecting a lower number, which then again implies a weaker currency. Now, quickly, what is volatility and COT report telling us? The COT report says Aussie is on its way to a potential long signal, but not there yet. It's quite interesting because this morning Citi recommended shorting Aussie dollar versus Canadian dollar at 0.9824, target 0.9625, and stop at 0.9930. This is for educational purposes only, and obviously we don't copy Citigroup's trades. We do our own trading. Also, be aware, you need to learn how to trade on your own. Don't follow anybody else. It's your money. Nobody cares about your money as much as you do. CAD also on its way to potential long signal, but not quite there yet. But pound, we have a potential short signal. We're very, very close. I consider it a potential short, and yen definitely potential short. Also, a beginning of April now, April 9th, historically towards the end of the month, the pound may turn. Volatility in the euro came off a little bit, in the pound came off a little bit, but still high. In the yen came off a little bit, and the VIX above 20. Recall, that means risk parity funds, potentially net sellers of equities. Option pricing, euro dollar and cable short for Monday, Aussie dollar long for Monday. Obviously, these pricings are from before the headline hit that China is looking at CNY devaluation as a trade war tool, and that really caused the Aussie dollar to sell off. That is unexpected, hence the reaction, the weak reaction by the Aussie dollar. Option flows, bullish for Monday, Aussie dollar, we can cancel that out. Pound and gold, they got that right. The pound did rally this morning. Bearish Monday, Canadian dollar, they got that also right. We only have 3 currencies that are weak this morning. That is the yen, the Canadian dollar, and the Aussie dollar. And we have euro and yen and Swiss franc weak. Okay, so they got all of that going on. Good. Here's the picture from this morning. Potential trade this week, long euro Aussie. And while I was working on it, Jens called me and said, hey, the morning meeting is about to start. Again, I apologize, I only had 2 cups of coffee. So let's do the chart together. Been a while since we did that. We start on the daily. I mean, we can even start on the weekly, and we see a pin rejection here and a doji and indecision. So market really, really not sure what to do on the weekly side here. And we see that we have some base forming right here. That's it. Weekly done. Let's go to the daily. Daily, we can adjust the fire a little bit to this price level, 61.50 area. That makes absolute sense. We can lower this a little bit right here, and then we have a swing right there. Good, that's the daily chart. If we expect this to be bullish, let's do a quick measurement of the fibs, and we can see that this 59 level held. It's a psychological number. It's good to go. So expectation could be for something like this. Liquidity expected above the swing. You see that? All pretty simple. So we can take this off again. Let's go to the 4-hour. On the 4-hour, we can adjust fire. We have a price level right here where the market did, we call this a tweezer, twin, close and reverse. It took hundreds of millions to hit this level and then reverse the position. That's quite interesting. Coming off, then this 50 fib level, off we go. Now let's go to the hourly chart and see if we can find some entry price. Let's shorten this up a little bit. Where was the target? Target was right there. That's interesting. Swing 1, swing 2. There's tons of liquidity. If it goes, then this will cause all of these assumed stops to trigger, and we have what we call a stop cascade. That would actually be quite nice in terms of rallying long. Oh, wrong button. Okay. Now let's take a quick look here. What are they doing? It's just POC. Aggressive buying into a top edge. We haven't hit that liquidity yet. That's above the market, expected to be right here. So we expect some liquidity here. This is really bad. This is really bad. Okay. And then we have some liquidity expected to be up here. Okay, good. So obviously we can't buy at the top. Only retail traders buy at the top, and the news are not significant enough that we have out of Europe to assume that the market will bounce. Also, we have a square up right here. So you may or may not like it, but the trade opportunity is, let's play it like this. Let's play position number 1 here. Let's see, we're definitely wrong if the market tanks right there. Let's do another trick, one more trick right there real quick. Okay, that makes sense. So I don't really need to put on more than 2 positions. We can put on here, this is tons of volume trading here. We have 3 POCs. It's expected to hold. If it drops below that, there's a little bit more liquidity expected right here, but not that much. If we really go below the low, okay, I got the trade, that's it. We'll do it like this. Position number 1 goes on here. Position number 2 goes on here. Your stop loss is 119 ticks below the average price, and our profit target needs to be at least 1.5 R. If it's up there, we expect it to hit that liquidity that's expected above 160. Let's call it 161 as a target. Okay, target 161, entry 1 is 159.85, entry number 2 is 159.10. Hopefully that helps. Jens, that is done for the day, 24 minutes, I believe, maybe a little bit less, maybe a little bit more. I apologize if it's more than that. We'll put on the trades, and I'll take some screenshots so that we know next week if they worked out or not. Thank you guys for coming in this morning.
Everything is fine. Tomorrow is another day, so hopefully tomorrow a new trader style. Everything is wrong or freaky today. I don't know how to say it best in English with your voice. Maybe you had a hard night or a hard weekend. I don't know. So all the best.
Sorry,
greetings and see you tomorrow again. Bye bye.
Bye guys. Bye bye.